Hello, I'm Mark Dunn, editor of investment magazine Portfolio Institutional. Welcome to this discussion, which focuses on emerging market debt. It's a big topic. In 2019, debt issued in the emerging world accounted for more than a fifth of the world's total, while emerging markets were projected to drive more than half of the world's economic growth. However, a year ago, the pandemic took hold, confidence was hit, and there was a sell-off. So what happened next? Where are we today in March 2021? Well, to help answer this, we've assembled a panel of experts, including asset owners, asset managers, and consultants. So let's meet them. Roger, could you kick off the introductions, please?
Yeah, Roger Mattingly. I'm a director of Ross Trustee Services Limited, one of the larger professional trustee firms. I chair 13 trustee boards, including 3 DC Master Trusts, and the other 10 are defined benefit final salary schemes. I've been in the industry for over 40 years, and I can say that because I think somebody else on the panel is slightly longer than that in terms of the industry experience. And obviously had to increasingly get involved in the various asset classes that are out there that are available to institutional investors, such as pension schemes, and emerging market debt is obviously one that's at the forefront of our minds at the moment.
Okay, thank you, Roger. Alejandro.
Hi, good morning, everyone. My name is Alejandro Arevalo. I am the head of emerging markets for Jupiter Asset Management. Have been investing in EM for now a little bit more over 20 years. I'm from Guatemala, so it's good to be from EM country as well, and a pleasure to be here.
Good to have you. Thank you. Kevin.
Morning, Kevin Westbrook from Capital Cranfield Trustees, previously a consultant with Aon. I've been around, as Roger might have indicated, quite a long time. Whether I've got any experience is another matter, but I'll leave people to decide that for themselves. Like Roger, a professional trustee and involved in a range of DB and DC schemes, particularly range in size, and I think size is one of the interesting things about whether smaller schemes can access asset categories such as EMD.
We'll find out, I'm sure. Rima.
Yeah, good morning all. So Rima Sen, I work on the credit manager research team at Willis Towers Watson. I work across both traditional credit and alternative credit, and in particular, I head up our emerging market debt research efforts and look forward to talking about it today.
Good. Thank you very much. Thank you. And Julia.
Good morning, everyone. I'm Julia Pellegrini from Allianz Global Investors, where I'm a senior portfolio management manager in the EM debt team. We manage a range of traditional and ESG sustainability focused funds in the EM debt space. I joined Allianz GI, which is of course the asset management arm of the Allianz Insurance Group in Germany, about a year ago. After a number of years at BlackRock and JP Morgan, I started my career in the international development and aid sector, working for the federal government of Nigeria and then for the World Bank a few years ago.
Good to have you with us. Thank you. And Gordon.
So good morning. I'm Gordon Ross. I'm the CIO at LGPS Central, which is one of the local authority pools that was set up 3 years ago as local authorities were pooling. I'm in my 41st year in the markets. I've always been an investor in the fixed income arenas, from conventional markets through emerging markets, but are now looking to outsource the pooled funds. And we have recently chosen and financed and funded an emerging market debt ACS for our partner funds.
Good. Thank you. I'm sure we'll hear more about that. And last but not least, Diliana.
Hi, everybody. My name is Diliana Daucheva. I'm heading the emerging market debt team at Cantria. We also managing a range of products. So obviously the full suite of emerging market debt offerings, hard currency, sovereign corporate, local currency, blends, as well as a sustainability range in the hard currency space. I have close to 20 years of experience working in the industry. I'm very happy to engage with that discussion today.
Actually, thank you very much. Thank you, guys. That's great. Gordon, could we start with you? You did touch on there what you guys at LGPS Central were doing in the emerging market debt. Could you give us a bit more fresh on the bones there of exactly what you've been doing in the past year?
So obviously we have 7, 8 partner funds. They all have asset allocations. They're controlling that. And we're looking to pool and make more efficient their allocations into various sectors. And emerging markets is something that they've been allocating to for their strategic asset allocation. And as I'm sure we're going to hear throughout the day or throughout this session, there are various advantages and disadvantages. And therefore, from an asset allocation point of view, they were looking to diversify their fixed income holdings. They wanted to create something that would be representative of the emerging market asset allocation. And so the managers we've chosen and the mandate we've chosen allows them to go anywhere within emerging markets, which, as you'll hear, will be between hard currency, local currency, and also local currency credit markets. They have different investment profiles, different risk profiles, and they'll be measured against the hard currency benchmark, which historically has been the one that's given you the better performance. And therefore, any outperformance will add to that asset allocation benefit at the issuer level and at the mandate level.
Got you. Thank you very much for that. Thank you. Kevin, you mentioned there you're working with funds of various sizes. I mean, has that had an impact on how they're accessing emerging market debt?
I think it can be a challenge, particularly for smaller schemes. They're effectively restricted to pooled funds, and there are a couple of issues with some of the pooled funds. Firstly is the cost. This is obviously more expensive. So if you're looking at a defined contribution scheme where you've got a price cap, clearly the price that you're going to have to pay is an issue, but also the availability. Are there funds available that give you the breadth? Because I think you really need to be able to access all 3 of the areas that were just mentioned: hard currency, soft currency, local currency, and corporate debt. And it's sometimes very difficult to find that in a meaningful fashion, where you probably also need some sort of active management. I think passive has a role, but it can be quite dangerous, I think, at times.
Okay, I'm sure we'll come back to that. Roger, the various schemes you're working on, what has their been attitude towards emerging market debt in the past year? Have they gone bullish?
Well, I think not dissimilar to Kevin's comments. I mean, it is a mixed bag out there in terms of a capacity to accept, both in terms of size of the schemes and also comfort factor and risk appetite within the trustee boards. I think 2020 has obviously been an incredibly volatile year for the huge number of emerging markets out there, and the blurred line between developed markets and emerging markets always slightly baffles me, and I'm not sure whether it's set in concrete at any one moment in time or it just is very fluid. But there were opportunities obviously during 2020, but I think going into 2021, that appetite for increased diversification, I think everything's relative, and the desire for and the quest for yield and diversification has probably never been greater as we come out of the pandemic. I think also there's as Kevin's emphasized, the need for active management in this market is probably as great as any of the asset classes, because the impact of the pandemic and what countries are going to come out of this in one piece and which ones aren't is actually absolutely key in terms of where the investment opportunities lie, and the resilience, but obviously the opportunity to actually make money and performance in the process as well.
Thank you, Roger. Alejandro, where are the opportunities in the emerging markets at the moment?
Well, to us, it's very interesting because, if we just take a step back to last year, the opportunities were just wide open, because you could say that EM was hit by a perfect storm in the first half of last year, where you had the pandemic, of course, you have oil under pressure, and the asset class was getting outflows. And it was a situation where it really didn't matter if you have the best bonds in emerging market. Everything was being marked down. In some cases, you see 40, 50 points down in a good name. I mean, it was the case where investors simply wanted to get out and ask questions later. And something that Roy just said, I think for active managers and dedicated EM managers, it was a fantastic opportunity, because when you look across fundamental sovereigns and corporates, and you see in cases investment grade names paying you high yield returns, it was just free for all. So the opportunities were very wide. I would say, you could say that even bonds that are very hard to source, where you were able to get a very significant discount. So opportunities were wide, but it's also about differentiation. And one of the things that going to this year, it has become even more relevant, because the rally, we had 6 months of very strong rally that in some cases, investors were just looking for the lower cash price to be able to outperform. Going forward, and especially now, given that most of the volatility that we're seeing is based on rates, on what we're seeing on this amazing pace of widening the U.S. Treasuries, I think it has opened again, attractive interest opportunity. For us, we are focused very much in Latin America, in CEMEA. We have moved away from Asia just simply because of valuations. I mean, it's not surprised to say commodities, but I think also when you look across what's happening in the US, in developed markets, the supply chain of countries like Mexico will benefit.
Thank you very much there. Julia, where have you guys at Allianz, where have you seen opportunities in the emerging markets since the pandemic hit?
Thanks. Well, since Alejandro just gave a very comprehensive report on the market level, I'll probably approach your question from a more investment process and philosophy perspective. I think what this pandemic has done in the midst of the distractions created obviously for our communities and our economies is also to remind people like us, EM debt managers, with the number of lessons that we thought we had learned last time around with the great financial crisis and the widening spreads we saw back then that Alejandro just reminded us of, right? So we saw much of the same playing out in March, April last year. And what that really did for me, I think, is to remind us, first of all, how much more correlated the EM debt asset class has become to global risk, global politics, global health issues. So that's something that has been playing out over a number of years, and that has only intensified. And it's a force that EM debt managers have increasingly to reckon with as they do their portfolio management. Just like we were saying last year in March, when we got then said Allianz GI that the pandemic was moving from Asia, and in fact, unfortunately for me, closer to home in Italy, it became quite clear to us that this thing was going to spread well beyond where it initially started. And so we had to find ways, despite being EM debt experts, to cushion our portfolio with hedging systems, and obviously looking primarily US Treasury is a way to cushion that blow to our portfolio. So first of all, the correlation aspect, which has increased over time, not least by the arrival in the market of something that Kevin, Roger, and others have referred to earlier in terms of the passive component of the asset class that has grown in importance and size over time. The second thing that I think you reminded us of is the importance for us, again, as portfolio managers, to really stick to your risk setting, really stick to sizing your positions properly, because, again, once you're in the midst of a crisis, but not only, you quickly see that some of those positions are hard to get out of, such as at the height of the crisis in March, April last year. You also, however, managed to pick up on some of the opportunities by allowing yourself that space, the room to maneuver, if you do your risk budgeting properly. So again, I think it's important lessons that we thought we had learned, and we were very starkly reminded of when the crisis erupted. And the last thing I would say is also the issue of doing your homework, doing your analysis, because just like, again, Alejandro rightly pointed out earlier, you had a sharp sell-off, but then you had a number of opportunities opening up, and you needed to be able to pick them up really quickly. For example, we got out of most of our Africa positions in March last year because we thought the spreads would widen significantly, being the sort of more fragile areas of the asset class, the more niche, the less liquid ones. However, that turned around rather in April, May, when we had a very important rally, particularly in the frontier market portion of the asset class. And those kind of markets where information is generally lower require a deeper level of analysis, require a pair of active eyes that look at them, and hence the importance again of active portfolio management to really pick out those opportunities. And last not least, that kind of analysis, I would say, is not just the standard macro fundamental at best political analysis, but really for us what's important is to integrate the analysis, and I hope maybe we'll get the chance to touch on to it again later in our discussion, but really going deeper into those kind of cases where social issues or governance issues or even environmental disasters can tip the balance for a sovereign or a corporate to be able to stay current on its debt. So I think the pandemic was a great sort of learning or refreshing opportunity for most of us if we have to look at the silver lining of this very difficult time for many of us out there.
Thank you, Julie. Yes, you have made some interesting points there, which we will.
Can I just add a comment on Julia's? I like that idea of returning to fundamentals, and I think when pension scheme trustees are thinking about this, it's something they need to do, asking themselves very, very basic questions. What is it you're looking for here? What are you thinking this asset category is going to be doing? Is it something that's going to be generating a stable income, so you're going to use it as an income generating thing? Are you looking for a diversifier in a growth portfolio? Or is it a kicker in your matching portfolio? Being very clear on your basic expectations from the asset category is going to be seriously important when you start to actually implement about who you implement with, how you go about it. So I think clarity of purpose has always been something that's important, and even more so given what we've seen in the last few years.
Thank you, Kevin. Thank you. Diliana, how did the pandemic and the sell-off, how did that impact your strategies? How do you guys at Candriam react to that?
So I cannot agree more with any of the prior speakers with respect to what have we learned and what the observations have been in terms of global factors impacting the asset class. That was definitely a feature. We had to deal with the pandemic, which we haven't dealt with before. Of course, risk budgeting came into play. We had to sharpen up our pencils and make sure that due diligence on specific countries is top notch so that we could take advantage of the multiple opportunities that opened up during March. To us, it was almost like a pleasant surprise that we could almost immediately roll out some of the ESG data that we had available in our sustainability framework. So already in March, towards the end of March, we kind of created the health dashboard. So this is like the basic data that is available on a broad basis for most countries. But that health dashboard obviously dealt with and indicated immunization rates, health capacity, child mortality, tuberculosis, which have to do with vaccination capacity. Yeah. And then, of course, we looked at the age group distribution for each country so that we know which countries may be more exposed within the emerging world. So, for example, using that data created a tactical opportunity to shy away from Latin America because it was pretty obvious that the health capacity was not particularly high. Despite that the age group distribution was reasonably okay. The concentration of population in large cities is not particularly, was not particularly helpful for larger countries like Brazil, Mexico. So for us, it was in a way the first opportunity to kind of more explicitly use from a tactical perspective data that is available in our screening, which indicated to us that actually we are not only discussing integrating ESG factors in our asset selection or analysis, we're talking about being able to functionally use them. That's one point. And then, of course, look, the asset class hard currency behaved the way it has behaved. The correction in 2008 and 2020 took about 6 months. The very difference between the two scenarios was that high yield actually recovered in line with investment grade in 2008 within this 6-month time frame, because of course we had one country defaulting on one bond, Ecuador at the time, while last year we had 6 countries out of a 74 country universe defaulting. And then of course debt levels have increased by on average 20%. We are not anymore finding ourselves in the best position from a debt sustainability perspective for the asset class. And we have to deal with topics like fiscal widening that has to be unwound at some point over the near term. Differentiation is going to be extremely key. We do expect more defaults to come through. In credit, we're going to be very cautious in obviously avoiding most of these defaults in the future over the next 3 to 5 years. They're probably going to be concentrated in, well, clearly high yielding and small issuers. We are very optimistic about the reflation trade this year. We are optimistic on the ability of the high yield versus investment grade component of the asset class to participate in the growth and reflation trade. We also constructive on commodities to the point of whether we should be considering the asset class as an income or growth, diversification of growth exposure. I would say that it's becoming very confusing because we have a 55% investment grade asset class component and 46% high yield. And those two do not behave in the same way necessarily. Obviously, the investment grade component is more treasury sensitive and it's more rate sensitive, and you should consider this traditional income component, while the rest is more growth sensitive, high yield, commodity sensitive, and it will participate more explicitly in reflation trades. So it is difficult to generalize the asset class because it's becoming more complicated, especially in credit, local currency. You find a similar differentiation with a much smaller universe. You have a 20 country universe with perhaps new countries entering as the local markets are developing. But yeah, we're dealing with more complexity, which offers more opportunities, where active management should play more active role. Perhaps last point, the experience of ETFs during the liquidity crisis of March, April, you shouldn't discount the fact that ETFs are still subjected to ETF discount and premium. So in the midst of a liquidity crisis, the pricing for ETFs is not ideal as it stands, because ETFs may be priced 7 or 8% lower than the, because of the value of the assets, may be priced on a specific day that much lower. And that sort of volatility is not what asset selectors or asset owners may be aware of or even prepared to take.
Thank you very much for that. Rima, is the way that investors are accessing emerging market debt changing or changed since the crisis?
Yeah, I would say so. So I would definitely agree with the points others have made around the importance of active management. That is definitely a core belief. But on top of that, I think investors have taken that one step further and are starting to believe in the value of specialists. By that, I mean, I think they're starting to recognize EMD is not just the one asset class. You know, there is the hard currency market, the sovereigns and corporates, and they all have different risk and return drivers. And that will also require different skill sets from your managers or whoever is implementing that for you. So we have seen investors increasingly willing to take a few more line items in their portfolio, for example, to make sure they're getting the specialist access in each area. And we find that sort of helps to hone in on, for example, if you have a regional specialist, it can reduce volatility simply from having the local networks and the local expertise that sometimes a broader team may not have, or for a lower governance client, if you have at least a hard currency specialist and a local currency FX specialist, you're dividing up that skill set. So we have seen that evolution, that generally the caution in EMD has started to diminish, and people are more willing to do a little more, take on a little more governance to really reap the benefit there.
Gotcha. Thank you. So, Roger, in your opinion, is it better to be active or passive when going to the emerging market, especially on the debt side?
I think it's become quite obvious from the comments so far that the active management, and it's not just active management, it is real expert in forensic management, in my view, and the analysis of the sort of policy responses to COVID and those that have been supported and either through central bank or the IMF, and trying to work out, poring over all those, I know there's the IMF tracker, but you can actually look country by country in terms of the forensic responses, but trying to work out the impact of those responses and the resulting indebtedness, and what that actually means to the resilience of those emerging markets is going to be a real challenge. And the distortion and the diversity within the markets, this is seriously not a mixed bag, is my perception. And the other thing I haven't got my head around is the impact of remittances. So my understanding is that in 2019, remittances were greater than foreign investment. And of course, that must have plummeted, or did plummet during 2020. And therefore, you know, the need for foreign investment probably in many countries has never been greater. And so it'll just be very interesting. And, you know, I can see some expert cherry picking amongst even the local currency emerging market debt could be incredibly beneficial, but the difference between getting it right and getting it wrong is going to be huge. And, you know, there will be serious winners out of all of this and serious losers out of all of this. And, you know, what the default rate will be, you know, who knows. And perversely, I think those that have come through the, you know, the Asian crisis and the Russian crisis and the taper tantrums, etc., all of those countries that have been affected by previous events may well have, you know, become more resilient this time round, and hopefully once bitten twice shy, that they could be more sustainable than those that haven't gone through that sort of issue before.
Thank you, Roger. Alejandro, other than about winners and losers, of course, there's been a heightened default. Has there been a heightened default risk in emerging market debt since the pandemic took hold, in your opinion? Sorry,
I didn't get the question.
Has the default risk heightened since the pandemic took hold?
I think there was, you know, last year, I think, I mean, most investors were expecting a huge amount of defaults across the asset class. I mean, we very similar to Julia as well, decided to exit Africa because we saw that, of course, there was the highest risk. But apart from, you know, the obvious defaults of like Ecuador, Lebanon, and Argentina, I mean, there was nothing else that really surprised us. You know, I think that, you know, something that Roger said, I do believe that the asset class has become more resilient. And you have many of the big players have learned from that original scene, right? Where you have that significant mismatch between asset and liabilities. Going into this year, when we think about defaults, I mean, we expect to be very much in line with last year. You know, even sovereigns, corporates around 1.6%. And the reason for that is that, you know, this excess of liquidity that we have seen coming in from developed markets over the last couple of years, many of companies and sovereigns have been able to take advantage of that. And by that, I mean that they have been able to issue at very low rates. We have seen many corporates tendering call debt was sometimes double digits. They have been able to extend duration. You know, a high yield on average was looking at 3 to 5 years. We're seeing much longer than that. And I also think that the COVID scare, I mean, shaped a lot of management and governments to realize that they need to be more cautious about how they operate, you know, about the big maturity walls, about liquidity, about diversifying. So when I look, you know, when we look at the medium term, I don't expect a very high amount of defaults. I would say very much in line with the average we have seen. And even if we see, I think that there will be, someone just said, sorry about the name, it's about high yield issuers, small high yield issuers, that I don't think there will be much contagion. I think it will be something that, you know, it has to happen. But I don't think it will be something that we will trigger a sell-off across emerging markets.
Thanks, Andrew. Julia, and do you agree? Are you seeing more resilience?
I'd say we certainly think that default rates will abate versus last year. That they will not taper off completely, unfortunately. We have similar expectations actually as Alejandro's team as concerns the corporate side of the story. From a sovereign perspective, in some of the most glaring cases, both Liliana and Alejandro reminded us of just now of last year, we think that we'll have fewer sovereign defaults this year. There's a couple of candidates that come to mind. There's obviously the latest news from Ethiopia asking for, you know, the G20, IMF, and other creditors for some debt relief in the context of the new common framework setup. But other than there's some talk around the potential for Mozambique or Sri Lanka to do much game. We don't actually expect Sri Lanka, especially, all the way to default. We think they will muddle through. For example, Mozambique instead is a more likely candidate for, again, common framework type of debt relief. The common framework itself is a very interesting new addition to the tool set of both EM debt managers and international financial institutions, which weren't spending maybe a minute on, and that is because what you have seen last year is essentially a couple of notable defaults or restructurings from Lebanon to Zambia, Ecuador, and Argentina, not having really a full playbook to go by. So you've had obviously Ecuador and Argentina, unfortunately, not defaults as well, going through a restructuring. In Argentina's case, a much protracted one. In Ecuador, a somewhat more successful one. But still on a very sort of ad hoc basis, as has been the case for a number of years now. Then you have the likes of Lebanon and Zambia coming through with their own problems. In case of Lebanon, deep social issues that made it so that the government at a certain point to decide between, supporting its population and paying external debt, given the tightness in public finances, or Zambia, there was, a much expected default for a number of years already. But again, this country digging their heels for now, looking internally, domestically at their own issues before really making steps forwards with creditors as concerns proper negotiations. And it seems like we're going to go towards using this new G20 common framework, which was approved just at the end of last year, which for the ones that have been in the industry for some time is really nothing but Paris Club on Evian terms. So essentially a setup whereby you have a country embarking on, first of all, that sustainability analysis with the International Monetary Fund that sets out a framework to get that country back on a path to sustainable debt. The country then agreeing on an IMF support program, which is we generally welcome. It offers us a good anchor to look at in terms of reform as well as financial support. And then the country essentially being requested to go out to all its other creditors, including the private sector, to request for comparable treatment. This has obviously generated waves through the markets, particularly when we started talking about this potential framework at the height of the crisis last year. It some of the wide spreads that we saw going into the summer. I would say that despite obviously default never being good news for any EM debt manager at the cost of something rather obvious, I would say that we would generally welcome the idea of a common framework, because if anything, it offers a framework to talk through these issues, a way for all creditors to sit at the table, and especially a way for a number of creditors that have been so far relatively reticent, such as China, to sit at the creditors table and have a conversation all together. So to the extent that it fosters transparency in debt relief proceedings, we welcome that. As it concerns defaults going forward, as a couple of notable cases, but we don't expect anything like last year. Obviously, provided that the global recovery up and the vaccination rollout program is successful across the world, despite different, obviously, rollout rates.
Good. Thank you very much for that. Diana, when you spoke last time, you did touched on places like Brazil, like Mexico, they've been hit quite hard. And a lot of the big sort of names in emerging markets have been held out, like South Africa, Brazil, India. When the pandemic is over and we're returning to normal, as it says, I mean, what kind of an impact do you think that's going to have on the whole investment case for emerging markets?
Well, capacity to manage any crisis is something that you'd consider in your creditworthiness analysis. So the fact that those countries have not delivered, perhaps in the amount expected on this, is going to feature negatively in our analysis. Of course, the issue is that different governments would have different perspectives on specific topics. So we're not talking about stable state of affairs. We're talking about the dynamic evolution. A lot of countries will have local elections or general elections next year. So Mexico has local elections this year, Brazil more general elections next year. We're going to obviously be faced with elections in Chile and Peru very shortly within the next month, Ecuador as well, second round. So we're talking about the traditional tracking of political dynamics in each country and what each new prospective government is going to propose in terms of policies. I think it has become obvious to all countries, DM or EM, is that the population is not happy with how in most cases, how the government has managed the pandemic. So in Europe, that has become obvious, and that has become obvious perhaps more explicitly in Latin America. To be fair, South Africa and India have very weird experiences in a way, because India had a very tough first wave, but actually, it's kind of outperforming on the second, perhaps because it developed immunity already in the first one. And in South Africa, I guess the younger population is like preventing the shocking distribution of the pandemic in the country. But yeah, what the pandemic has taught us is that you have to really analyze multiple dimensions and maybe introduce different data in your analysis. So real-time data is something that we all learned how to start following, next to political dynamics, next to biases of a specific government, next to ability. It is a fact that we have to rely a lot more on high-frequency data and on Twitter to get news for those specific countries. So in terms of sources of information, we had to, the world has sped up in terms of how the information is being produced, promoted, and used. And for the rest, frankly, I think the pandemic has posed challenges to policymakers globally. The lessons learned will have to be, you have to develop preparedness, and you have to build out your health capacity, and you have to think about what they're doing in terms of immunization. But yeah, these are more generic comments. I just wanted to add something to the previous discussion. Yes, there's a G20 initiative, obviously dealing with the high stock of debt in specifically some of the sub-Saharan African countries, mostly impacted. IMF has been quite active as well to offset the potential decline in FDIs to those countries or any financing. So as you're aware, emergency funding was made available to 85 countries to the tune of 107 billion. The ongoing discussions, that was only in 2020, there's still ongoing discussions about increasing the SDR pool for the International Monetary Fund and the new US administration. That's a lot more likely to happen. That means an automatic increase in the reserves of a number of EM countries. There is going to be, there has already been, and it's going to be, we're going to see more policy support on behalf of international institutions like the IMF, the World Bank. Yet countries will need to deliver on that sustainability as well. And they have to figure out how to bring that and fiscal deficits down from the very extreme levels that were accumulated by 2020. I just wanted to mention something else. Rating agencies have not considered to give countries, sovereigns, developed or emerging sovereigns, the benefit of the doubt. They still consider something like 50-60% of debt to GDP as a sustainable level. The fact that the US has moved to above 130% debt to GDP, or that some EM countries have moved to the same level, does not mean that the benchmark and threshold is going to move up. So that would mean that in the near term, you're still likely to see more downgrades in both the developed and emerging market world. And we have to be aware of this adverse dynamic as well.
Thank you very much for that. Rima, through your work, are you seeing a change in how managers are approaching risk in emerging markets?
Yeah, in a sense. So when we're speaking to our managers, obviously we have the luxury of most of our clients being long-term investors, being institutional. So we tend to revisit the strategic case, which we all know and love, so I won't repeat quite often. I do find now there are elements like ESG, which Diliana mentioned, which become more and more prominent as you see the sort of flavor of crises change. It's no longer just a debt sustainability. It could be anything thrown at these nations. So what we are doing now is checking the risk framework is more robust, is more three-dimensional. Are you considering the ESG risks? Political risk and governance was always there, but let's think about things like the health data. Let's think about the external impacts, how has resilience changed from 2013 and the taper tantrum. So it's really a revisiting on the lessons learned, but ensuring those lessons were learnt in 2008 and 2013, and the risk framework is there to encapsulate that, plus the sort of new risk that can come at you. And I think that requires just a little bit of three-dimensional thinking and incorporating these new elements like ESG and other areas.
Gotcha. Thank you very much. I'm sure we'll get on to ESG soon. Alejandro, the US has had a new government in the past few months. Would that mean anything for emerging markets?
Yes, I definitely will. I think Liliana just said something that is very much related to this. I'm so glad that with this new administration, I don't have to wake up in the middle of the night to check Twitter, right? Because you never knew exactly how the new administration, actually Trump, was feeling that day. So that's something has been, to me, very positive. But joking aside, I mean, to me, the new administration is extremely positive for emerging markets. It's very obvious that you have someone that is more experienced, that is more predictable, and less willing to make just unilateral decisions when it comes to foreign policy. So, what is definitely something that a good change is that they're having to forge alliances, with man-like countries to try to see or try to tackle what they see as the main risk. Let's call it Russia, like we saw yesterday, for example, or China, and that's definitely in a good step. I think for us, one of the things that the markets don't like and the previous administration was bringing to the table was volatility, was uncertainty. We didn't really know who was going to be the next victim. And at the moment, we're still on a wait and see mode. How they're planning to tackle China, for example. But I definitely think it won't be now just focused on trade. You're going to have property rights. You're going to have also Hong Kong. You're going to have different scenarios that they will need to look and try to come to an agreement with other countries how they should approach it. And that in a way is good, because you're going to have, it's going to be better thought, and it's going to be also in a way that it will give us, I believe, enough time to be able to adjust our views and in some cases our portfolios to be able to reflect what's coming down the line. So overall, I think it's definitely a good thing.
Can I just add something there about some of the basics, given the discussion about the US just brings to my mind the third factor that you've always got to think of in investing in emerging market debt. We've spoken about yield, we've spoken about defaults, and then you've got the currency. Do you go for hard currency or local market currency? Which seems to come down to an argument about where the dollar's going to go. Is it going to get dragged down by deficits, or is it going to go up with rising interest rates? That's just, those three factors. You've got to balance all of those in coming up with your proposition for where you invest, which I think from a trustee looking to invest, trying to find a manager who can juggle all of those, put those arguments in front of you and come to conclusions is really quite challenging, because that manager's got to have both the strength in depth to do that analysis, some of which we've heard of already, that detailed analysis, but they've also got to have a big enough picture to be able to say, don't invest. Somebody once told me, you never phone up the Japanese equity desk and the person there says, don't buy Japanese equities. So that's one of the challenges here. You want a manager that's prepared to say, don't do these things here, but can actually drill down to the level of detail to find those serious opportunities that are there. So it's quite a challenging, quite a daunting prospect in some ways from a trustee's perspective.
Gotcha. Okay. And what about you, Roger? Has a lot of uncertainty been removed, perhaps from the emerging markets with the change of government in the US?
Well, I think, yes, I mean, hopefully trade tensions will be much less than they were under the Trump regime. So, that must be good, I would have thought. And the points about currency are obviously very pertinent as well. So I think, I still, come back to, and I know I'm slightly answering a different question, but I still come back to how countries have been impacted by the pandemic, how, and we touched upon Brazil, India, South Africa, etc. But the rollout of the vaccine now is pretty pivotal to all of this as well. And obviously, there's without having absolute knowledge of the facts behind what's going on in terms of the vaccine wars that are in danger of happening. There's obviously some politics kicking in terms of vaccine availability, etc. But you can see, those economies that are dependent on the likes of tourism and leisure, etc. If they have very little, i.e., marginal vaccine coverage over the next 12-18 months, their economies are going to struggle to recover at all, and because it's only going to be very hardy tourists that are going to go to areas that still have the pandemic in its prevalence. So that is answering a totally different question, Mark. So apologies, but yeah, I think just the sense of calm that the Biden administration will bring should be beneficial to emerging markets, in my view. And I think beyond that, I think I will leave it to my expert panel colleagues to be a bit more expert in terms of the response to that question.
Gotcha. Thank you, Roger. Thank you. Julia, what about you? Has this in any way impacted your strategies?
Sure. So sorry if I understood correctly your question around President Biden and also some of Kevin's comments around allocating to the asset class. I would say definitely a welcome change in perspective at the White House, not so much in terms of political colors, which we're quite agnostic about, but rather for that predictability, a rule-based type of particularly foreign and economic policy, which as an investor we welcome. That is rather clear when you consider, for example, the situation in the Central American area, or even in the Middle East and Near East area. Biden that quite clearly has put as his key objective a deal with Iran in that context, even though yesterday he spoke rather openly and clearly against Russia's attempt to interfere with US elections. He will play that rather carefully because he will know that Russia is a key actor in that context of achieving a deal with Iran. The same will be for Turkey, which in the past 4 years has come under a lot of fire. Well, depending on the time of year of the season, if you like, you had a budding relationship between a Trump and an Erdogan at a personal level, and then quite a lot of pressure being put on Turkey from instead a more sovereign political perspective. So we think those elements of erratic policymaking will change. Predictability is generally welcome by investors, whichever way it goes. Again, rather agnostic about it, but just the sense of being able to have some foresight as to the direction of travel in countries in the context of global politics will be important. And the same goes, for example, Central America. You have a Biden that now is talking back to the likes of Bukele or, Honduras, where you've got a president that could be, implicated in drug trafficking scandals, and a US administration that says we will continue to support you because quite clearly you are an avenue for migrants to reach our shores, and we want to be able to have a say in that. But we will be doing that more carefully as to how you respect human rights and the rule of law, for example. So these are all very important elements for an investor to take into account, and that kind of rule-based policy will help us a great deal, I believe. On Kevin's comments more specifically, if I may comment, the way we approach allocating to the asset classes, rather to say, because the markets and year and a half have proven this, do change rather quickly, and you've been into this kind of regime shift change, deep bearishness, then some positivity with the turn of the year, with vaccines coming out, but also US elections and how that has changed the perspective for emerging markets and so on. You want to be in the asset class already, but being able to flexibly allocate to the different components. So for example, without going into details, but we've seen a lot of interest in our select product, what we call essentially as our more flexible fund, invest in the three main asset classes: our currency sovereign, hard currency corporate, and local currency sovereign. And effectively, we tell our clients, we will do that asset allocation for you because we understand that some of these changes will be more tactical in nature, some will be more structural. But if you wait for that change to materialize, to allocate, you will effectively miss the bus, and valuation will move on you, the political situation will change, and so on and so forth. So being able to provide that flexibility for us has been a winning position. That obviously goes alongside the very discussion we were having with some of my peers here, Diliana, Alejandro, on economic fundamental analysis, ESG analysis, political analysis, that obviously you cannot abstract from that. But it helps if you have a more flexible approach, because I think clients recognize that you'll be able to do on their behalf that very asset allocation that otherwise they may be a bit struggling with in this context of this ever-changing world, really.
I think that's a fascinating point that Julia makes there, which is just another complexity for poor set of trustees to struggle with. Regime change, which is another way of saying, is the past a reliable guide to the future? Is this a manager who looks at historic trends and builds on those, or is it somebody who says the past may not be a very good guide? Deficits have dragged the dollar down historically. Perhaps this deficit is a different one. So it's just another example of why you need that active management, that brave thinking. But it's quite difficult from outside. Really, you must have this. When you're telling people about this, how do they trust the credibility of the people they're listening to?
Yeah, I think there's a few ways of doing it. Again, appreciate that one way is let's give our managers the flexibility and have them allocate. However, if you want to use that specialist approach where I think you are the best at hard currency, so I will give you money for hard currency only, you can do things in terms of the mandate design to try and control some of those risks and those concerns from a trustee perspective or a client perspective. So for example, on the local currency side, we've worked with some managers to actually design a mandate that lowers the volatility of local currency assets by giving some flexibility to move into developed market assets when you feel like everything in EM is going wrong. It essentially gives you somewhere to hide. So there are a few ways of doing it, and it doesn't necessarily always have to sort of be you entirely putting your faith in a single manager to do everything in the asset class, because again, there's so many opportunities and then so many different skill sets. You can sort of take a little bit of control of that and do some things with mandate design as well. Got you.
Thanks for that. We have got a lot to get through, so I just want to move on to another issue that could be hitting the emerging markets. I read that we could be entering a new commodity super cycle. If true, Diliana, what would that mean for your strategies?
I think it's, as we discuss emerging market credit, so hard currency is a very diverse universe. There are opportunities to play interest rate sensitive and growth sensitive assets, but to be fair, completely fair, we are finding it difficult to play, let's say, the copper commodity super cycle. Copper is going to be one of the most desirable metals from the perspective of the recovery of the old economy, but also building renewables industry and more tech globally. So basically, you'd expect that this metal specifically is going to be supported. Demand for this metal is going to be supported. Of course, Chile, Peru, Zambia, large producers of that. In sovereign space, it's kind of difficult to play. You have to look for almost equity exposure. Even in corporate space, the valuations are not as attractive as they could be. Currency is another way to play it. You'll probably focus on currencies because they're the most growth-sensitive assets within our investable universe. In terms of oil, look, I think that at the moment we are finding ourselves in less supply than demand conditions. So clearly we have a positive technical situation for oil. Most investment banks have upgraded their forecast for average oil prices towards 70, 75 or higher. It almost feels like it's going to be the last hurrah for the hydrocarbon sector because there is push from regulators to disinvest from those sectors and to guide the traditional oil producers into developing renewables. There is talk about the capacity of former oil companies in terms of extracting oil from the ground to actually be maybe more advanced in terms of providing the technology or the know-how to produce hydrogen type energy products. So I think the hydrocarbon industry is faced on the one hand with two conflicting forces. One is supportive reflation, so demand flow should be increasing, supply is not as high as it can be at the moment, and in the long term we are going to deal with issues of small investors being pressured to disinvest from traditional sources of energy and into renewable and cleaner sources of energy. And this is becoming not only an ESG theme or a factor that we track. I think the Europeans, in terms of European Central Bank and European regulators, are looking to enhance the disclosure of how you track your sustainability factors in your portfolio. And there are certain sectors that are not going to benefit, and the extractive industries may be that. But all in all, we're very happy that commodities are constructive in a year in which we have detraction in terms of total return for any EMD segment from the treasury rises. We're finding ourselves in the growth cycle. I would not call it a regime shift. It's more about this cycle, this part of the growth cycle where we are growing. So basically we are growing out of the crisis. EMD on average, having said all the things about differentiation being required within the asset class, it's still offering risky asset class type returns. So for both hard currency, local currency, we're going to get 5% roughly. So the carry of each of those segments. Of course, the risks around local currency are always higher because on the one hand, currencies appear quite cheap from a longer term perspective. On the other hand, the strong dollar trend around inflation in the US or outperformance of the US and exceptionalism of the US economy in the first half of the year is a pretty obvious and strong trend. So all in all, hard currency in the end, like every year, becomes the more or less the preferred spot. And of course, I cannot disagree that you need an active investor because there will be shifts within the year of when FX may perform well, and you have to be able and willing to position into some of those moves, and the same counts for corporates.
Okay. Does anybody else have anything to add on the commodities super cycle? Okay.
I think
yes,
just one comment. I think in the old days, emerging market was divided into the oil consumers and the oil producers. And I think what you've just heard in the comments mean that that's not only many of the other variables are influencing emerging markets, political, geopolitical, and domestic politics. But this super cycle, if it does come about, or even if it doesn't come about, the mixture is no longer quite that easy to allocate just between those two segments, and the markets will continue to behave very differently than they had done historically. So again, in a comment of do you take historical performance or behavior to go forward and I suppose map that out into your asset allocation or your expected returns? I think it just made it even more difficult. Add that to the currency weightings and the domestic currency and the government. Should you be allocating to a domestic sovereign because in theory they can print money, or to a sovereign and hard currency because in theory if rates go up and the currency goes against them they default? There are increasingly a number of variables, which again reiterates the comments and the consensus here of the active management, and from our point of view, active management with giving the manager as much discretion as you can to leave it to the experts.
Thank you very much for that, Gordon. Thank you. Shall we move on to, we've touched on this, shall we move on to ESG? Kevin, when it comes to emerging markets, are your schemes that you're working with, are they managed to work ESG into their investment decisions?
Yeah, it's one of those things. ESG is becoming all pervasive, and even asset categories where you wouldn't necessarily have started from have got to play the game. I think the thing that I'm seeing is that you have to avoid the sort of the knee-jerk reactions. So pick an example, Chinese EMD, there'd probably be a knee-jerk reaction that says, because of what's happening with some of the minorities, that's it, out of it. Well, actually, I think if you dig a little bit deeper, you'll find that some of the Chinese corporations and companies have got some very robust, solid approaches and disclosures on ESG matters. So I think you can be surprised sometimes at just what is going on underneath the surface. You have to take the time to find out and get in there. But I think it will undoubtedly, ESG analysis will undoubtedly play a serious role in EMD going forward.
Okay. Alejandro, ESG, emerging market debt, is this something you're factoring into your decisions? Is it playing a big role for you going forward?
Absolutely. A client asked me the other day if this is something that is transitory or is here to stay, and absolutely is here to stay. I mean, something that it needs to be part of your investment process. And it's not only because I do think that it adds value. I mean, you can uncover value over the long term, but it's also something that investors are looking for, and for us, it's a combination of, improving and continue to improve your process, but also, having that external forces eyes looking into it. And unfortunately, at the moment, there's no formal ESG process in emerging markets. So each company is up to them to find the best way. And I think we're moving to a universe where there will be more issuance. I mean, there's more demand. I mean, we just last year, I think it was close to 3 billion that was in new issue on ESG. And you can see that is the way forward. And I do think also companies have started to realize that. So you are more empowered now to try to make changes. We have been very proactive, for example, with Brazilian protein issuers to make changes. I mean, what they're doing with the Amazon, what they're doing with cattle, and they have actually incorporated those changes into their plans. I do think that at the sovereign level is slightly harder, right? Because it's more, you see more investors, different size. But at the corporate level, I think you can still do quite a lot of good and influence as long as everyone is moving on that direction. So yes, I mean, ESG is something that it adds value and is here to stay.
Gotcha. Okay. Julia, we heard from Kevin that he's seen some quite robust standards in ESG across emerging markets, especially in China. What about your experiences? Are the standards of transparency in ESG quite high? Are they improving? Do they need work?
One step forwards, there's work to do for sure, as both Alejandro and Kevin were alluding to. That's undeniable that in some pockets we still have more work to do, for example, as concerns corporate governance. I think from a broad ESG perspective, what's been very key is the renewed interest from clients in this asset class. So we have clients now coming to us to ask us, how do we go about investing in ESG manner? It's no longer us proposing a way of looking at things. We've been doing ESG, as you know, at Allianz for about 20 years. We launched the first ESG focus funds on the equity side about 20 years ago. We just had its birthday in-house. We have adopted for a long time as a way of doing investment, particularly in emerging markets. What we're seeing now is the reverse. We've got clients coming up to us to ask us more about it. And that is for a couple of reasons. Obviously, the pandemic, with the horror that it has brought on us, has brought to the fore a number of questions around, again, global health, around how to your savings in a more responsible manner for the benefit of the planet, but also of your community around you. So all of this has been, if anything, again, the silver lining from this experience we've had. But the second reason is because you're starting to see the returns. We've been talking about EM hard currency sovereigns as an asset class, for example, as the go-to for everyone in the EM world out there for a number of years. If you look at the standard JP Morgan MB index for hard currency EM sovereigns, and you look at the ESG equivalent, you'll see that over the past 8 years, the ESG equivalent has outperformed the traditional index by 2.4%. Now, that's if you look purely from a buying the index perspective, a passive approach. If you use an active approach, we believe you can actually use ESG to enhance your ability to deliver returns to the clients on top of what a standard level ESG approach can give you. And that's why we've been spending a lot of time really teasing out all the inputs we can get from our proprietary ESG sovereign framework, where, for example, we've decided to move completely away from third-party ESG data providers. What we've noticed is that ESG data providers out there have done improvements in the way they do their work and they collect their data. However, you will see a wide variety, a wide spectrum of outcomes in their assessments of the ESG credential of a corporate or a sovereign. So what we said is, why don't we just do ourselves our own framework using publicly available data? The framework is published, everybody can check it out and come back to us with comments. All the indicators we use are out there for everyone to see. So we give comfort to clients in terms of that transparency. We pick the data and the indicators that we believe are most correlated to markets that actually have an input in the way that asset prices will move, help us as investment managers. And we have a much sounder framework overall. Obviously, all of that using publicly available data means by necessity that you use data with some lag, that you're using data that at times is rather backward looking. If you look at, for example, Freedom House or UN family of agencies that provides a lot of data, all of that is rather backward looking. So obviously, being an investor in the financial markets, you need to have a much more forward looking approach. So we thought, how can we do that? And what we're doing is working with artificial intelligence on a natural language processing model. I won't go into the details of the coding side of the business, although it is quite exciting, to really come up with these higher frequency indicators to exploit some of the market information that is out there from corporate filings, from regulator decisions, from news on a daily basis, to give us that edge in terms of a more forward-looking approach to ESG investing. Because we do think that going forward, you will see a lot more innovation in the space, and some of that has to do with the data you use, so we're working towards that. And some of that is to do with the issues that you see coming in the market, some of which Alejandro was alluding to, you know, green bonds, social bonds, sustainability linked bonds. We're seeing more and more of that coming in the market, mainly from the Latin side of the story, but we hope increasingly from other geographical areas. So it's definitely a field in evolution, but I would say to conclude that the demand now more and more is really coming from the client, that they're seeing we can produce returns, we don't need to trade off returns to invest responsibly. And given what's happened, we're reminded of the importance of this as well.
Thank you very much for that. Diliana, how are you implementing ESG factors into your emerging market debt decisions?
So that's a very good question. So I have to reiterate that there is no market standard. And then, of course, every fund manager will have to define their own framework, and it's everybody's choice whether to design a proprietary framework or to use external providers which accumulate the data and provide some sort of a scoring, similar to Sustainalytics or Rep Risk, the inputs that JP Morgan is using to construct the index. So basically, what we have chosen to do is to design for all our processes, not only emerging market debt, but the remaining fixed income and equity processes, proprietary frameworks. We have an internal ESG team which has been set up and operated very successfully for the past 20 years. We have run for the past 5 years a very broad sustainable fund range. We are actually one of the first managers to launch this. And then we offer products in fixed income equity space, and as we mentioned already, hard currency sustainable product. Our experience with that product has been quite positive, frankly. The risk-adjusted returns over the past 4 years, or its existence now closing on the 5th year, have been quite positive. The product outperformed. The product does have a slightly defensive bias, so limits the volatility of the product by limiting exposure to some of the high-yielding, lowest-rated parts of the universe. All different considerations. It could be social governance or environmental indicators, but all in all, combination of those, and we have a very holistic approach in terms of tracking all available data on the ESG category. You end up with, in the end, a more defensive product, which in the end does not particularly underperform the asset class in up years, but specifically outperforms the asset segment in down years. What I wanted to mention as well, as emerging market debt investors dealing with analyzing sovereign risks, it is silly not to confirm that we have always dealt with social governance indicators. So we have to look at how a country is able to attract or manage investments from abroad, because capital is required for development. So in the end, social and governance indicators have always been part of our analysis. This is not anything new. Mm-hmm. So those social governance indicators have always been part of the creditworthiness analysis because they determine the ability and success of a country to process investments and to grow. Structural reform trends are part of this analysis, and of course they have to incorporate a number of those ESG metrics as well, or are measured by a number of those World Bank or IMF indicators that have traditionally been used. Governance indicators dealing with the state of democracy in the country or the strength of institutions have always been extremely important because we have always analyzed political risk on the side next to our fundamental assessment, as political risk can be and remains a big driver of returns in the emerging world, where political systems are still under evolution, and we may have swings between left and right with different outcomes for society and for the economy. So this is something that we have been tracking. What we haven't tracked as an asset class, and what we have decided to incorporate more explicitly in our sovereign sustainability framework, is the environmental impact and the environmental impact of development. And how we have restructured our sustainability tracking is by actually focusing on strong sustainability. What we mean by that is assessing the impact of building any source of social or economic capital on the environment. We do think that the environment cannot be considered to be on equal basis, substitutable relative to other forms of capital. And also, once you destroy your nature or forest, I mean, there is no development that you could extract out of this, right? You need to manage your natural resources well in order to progress as an economy. And I have to say that a lot of countries have started focusing on basically how they're perceived by investors with respect to ESG factors. Of course, we have champions and leaders in that framework like Uruguay, which have always produced the medium-term sustainability framework. Chile has joined that, a few other Latin American countries, but more surprisingly, as per last year, in my conversations with Middle Eastern economies, which are primarily extracting the wealth from hydrocarbons, there have been quite a lot of questions as well on how to present the medium-term framework. There are more opportunities for countries to express the development or ESG development goals via self-producing or producing reports that deal with the medium-term frameworks within the context of the UN development goals, and how the meeting those 17 development goals that the world is moving towards. So basically, in our framework, first it's proprietary, then it has shifted as a focus on the environment. The pandemic, in a way, as we've already discussed earlier, has indicated that we have that this framework, this bias kind of adds value. We would welcome any more consistent tracking of ESG indicators. We would welcome, and we try to help countries in any way possible in our conversations with them, with advice on how to improve the sustainability tracking. Same goes for companies, of course. You'd provide the feedback on what is the best market standard, or what are the companies you should, in a way, copy in terms of disclosure.
And thank you very much for that. Time is pressing. And before we move on to our final question, does anybody else have anything they want to say on the subject of ESG?
Yeah, Mark, I think,
yeah,
all I was going to say was, and I think the point that was just been made about how emerging sovereigns and corporates are perceived by investors is only going to accelerate and heighten over the next 12, 18 months, 2 years, as TCFD. I don't think any emerging market participant should underestimate the pressures that are increasing on institutional investors in terms of their reporting obligations, in terms of the financial materiality of those investments that are taking ESG considerations seriously. And we've got COP26 at the end of the year as well. I had a letter from the minister a couple of weeks ago asking for my response in terms of the appointments I have in terms of what we're doing on ESG. Of course, it's not just about climate change, although climate transition risk and climate physical risk is a major part of it. It is investing increasingly in companies that are perceived to behave themselves in terms of how they look after their staff and their workforce and their supply chains, etc. So it's almost it's gone from being possibly almost optional to now, if emerging market corporates and sovereigns want investment and need investment, and they will increasingly after the pandemic, they have to be ESG friendly in terms of how they're perceived. It's no longer optional. It's increasingly a necessity to attract foreign investment.
Yes, Rima.
Yeah, I'd agree with sort of Roger's points there. I think what's important for our clients is that these ESG risks are increasingly becoming financially material. So there's two sides to it. What are our exposure to the negatives of ESG risks, and how can we also impart positive impact? And we want to make sure managers are thinking about both of those things. And the way we encourage that is saying, okay, you need the robust integration, either through proprietary scoring or your external data, etc. You need to make sure those risks are considered. But on top of that, are you engaging with issuers? Are you talking to the sovereigns and the corporates? Are you providing that advice? Are you talking about the issues that are most relevant to your investors? So it's that two-pronged approach that we feel is vital. Otherwise, it might be easy to overlook either the risks or the potential positive impacts. So yeah, and I'll just also add finally on the governance point, we have seen historically a lot of managers say, oh, we cover ESG because we've looked at governance for X number of decades, as any EMD manager would have, and we have seen that conversation moving on quite substantially. E and S are becoming increasingly important, and absolutely they should, but I think it falls on our clients and us as consultants and other advisors to keep pushing for that, particularly in EMD, for that conversation to move beyond just governance.
Yeah, I liked Alessandro's client's comment, is this a fad or not? I think in 10 years' time, people will look back on us and say, you mean you didn't invest using ESG? It'll switch so dramatically. But also listening to Julie and Diliana talking about the way they go about it sort of highlighted one of the frustrations sometimes about ESG. There's no agreed method, and that's frustrating. At a trivial level, if you ask for an ESG score of a company, agent 1 gives it a positive, agent 2 gives it a negative. That feels silly, but I suspect you have to keep working beyond that and say, well, hang on, ESG is totally embedded in the way that a manager goes about their work. Not every investment manager goes about their job exactly the same way, so we can't expect them to have a single way of doing it for ESG. What I think we have to strive for is consistency of the underlying data, because the manager can put whatever interpretation of the data, and that applies just as much in the EMD world as the corporate world. So I think there's plenty to play for here still.
Yeah, and there's an argument to be made, does the inconsistency almost creates an ESG alpha opportunity, which is the next frontier, I guess.
Okay, guys. Final question now. It's an open question. What I'd like to know, and some of you may have already touched on this in some of the answers you've given today. I'd like to know how you're seeing the emerging market debt market in the next 12 months. What are you expecting to see? Would anybody like to just summarize their thoughts on that?
I'm more than happy to go first, Mark. I mean,
Okay,
I
Roger,
think,
yeah.
I mean, I'm expecting with the active expert forensic management that is, in my view, a necessity because of all the intricacies that we've talked about today. I'm expecting a sort of mid to high range of single-digit performance over the next 12, 18 months. I think it's perfectly achievable to have high single-digit returns. The ESG component is absolutely essential to that, though, and because of the financial materiality, but also because of the perception point of view that was so pertinently made earlier. So I think there are a huge amount of opportunities during 2021, but the pitfalls are going to be all over the place as well. And so avoiding the pitfalls, I think if you avoid the pitfalls, the benefits could be huge, but it's not easy to avoid the pitfalls, I guess.
From our point of view, obviously we're looking for positive returns. The year's not started off very well, but a lot of it will be dictated by how you view it. Most of us are representing sterling institutions. The pool represents sterling defined benefit pension schemes. It's all in sterling. So the minute you have any currency, especially emerging currencies, then hedged back to sterling, you can have a cost, invariably a cost there. So it depends on whether or not you get it from an asset allocation just to those local currencies, or you take it back into sterling and reduce some of the risk, or you have what we would advise to let the managers trade the currencies as well, but make sure they know they're measured in sterling terms.
Okay.
I think not so much a market idea, but I think a structural idea, which is I can see emerging market debt starting to play an increasing role in deep defined contribution schemes as they start to get to grips with the decumulation challenge. You're going to be looking for assets that give you relatively high levels of income, stable income, plus or minus the currency point. So I can see that over the next few years, you'll start to see emerging market debt featuring in some of those decumulation solutions in the defined contribution marketplace.
For us, looking into, what has really created the volatility so far has been the pace of US Treasury widening. For us, our main thesis going into this year has not really changed. We still think that this global reflation, global growth will benefit emerging markets. But like Roger said, and we have been discussing across this hour and a half, is everything's about differentiation. And one thing that I'm very clear with investors, you cannot put all emerging markets in one boat. You have different economies going through different points of the cycle, and you need to be able to differentiate that. So for us, I still think that it will be a positive year for emerging markets. I do think that as dedicated EM fund managers, this volatility is good for us. It's also very relevant to have a robust process, think about portfolio construction, managing the drawdown. But when you're starting to see again valuations being attractive after such a prolonged period of just spread tightening is good. It's never on a straight line. Volatility is part of the asset class, and we have to be ready for it. We know how this works. It's just taking advantage of this to be able to continue to buy credits, sovereigns that we value, we believe in the long-term fundamentals. It's very difficult. One of the things that, I always like to say, it's very difficult just to, it doesn't work to be a short-term investor, because you have a lot of volatility, and it's very difficult to time the market. So when you have these scenarios of everything going down, we can still sleep at night, because we know that the credits that we hold in our portfolio will be able to repay the coupon at maturity when it's due. So for us, is having good names through the cycle and take advantage of volatility to add more value.
Thank you. All right. Okay, is that our final comment of the session?
Oh, a couple of thoughts. Sorry, were you asking me? Otherwise, I just read it. Apologies if I interrupted anyone else. We are very much in line with some of these comments. We expect mid-single-digit returns for the rest of the year for the hard currencies or an asset class in particular. Much like Roger was saying, and Alejandro as well, of course, they will be important to avoid some of those pockets of drawdowns, much in the way as we did last year. That will be key to your alpha making potential as an investment manager for sure. And ESG is at the very heart of this, being able to dodge those curveballs. In terms of the broader market view, particularly after the Fed messaging last night, with that the reflation trade remains our base case. Quite obviously, the increase in interest rates in the US will not end here. We continue to see them rising, except it will not be, in our view, quite a sharper rise as what we've experienced over the past month or so, which has been rather disruptive to the asset class. So a more supportive backdrop global risk with a more paced rise to US interest rates. That obviously has an impact on our asset class, but you can manage it better because it's more paced, with reflation being still the name of the game, but pockets of inflation scares in specific countries where we'll pay to do more analysis, because there will be countries that have less room to maneuver in terms of that hiking of rates to contain inflation, and hence having to dampen the potential recovery in their domestic economy.
I would just add, sort of agree on our view that overall it would be a positive year for the asset class, potentially a volatile one though, and we'd expect a little bit of volatility. What we'll look to do this year is constantly remind clients of sort of, again, the strategic cases. This will remain a valuable diversifier, and that's even more valuable now than it has been in previous years. For the cyclical diversification, not just geographical, etc. So it's going to be a case of sort of making those reminders, I think, to investors and clients as well.
Liliana.
I just wanted to add that basically, in a way of a summary, our top-down assessment is also pretty much in line with our competitors. So obviously, we agree with Alejandro and Julia on the global picture we are facing. We agree with the fact that we could hedge some of the treasury exposure, the asset class that we are facing. It's important to have active management of your treasury exposure and of your strategy. That's quite important for asset owners to understand. We know that it's going to be a big year in terms of differentiation. And I think it's quite important to start tracking how ESG factors are going to start impacting our decisions as asset managers. And of course, from the perspective of asset owners, that's an important thing to track. ESG risks have clearly are gathering more attention. Regulators are definitely paying that attention to energy transition and of course, social governance metrics. And I'm looking forward to basically testing the academic findings from the past 20 years and assessing how much of the ESG risk premium are we going to start incorporating into our sovereign or corporate creditworthiness assessment. So managing those ESG risks is something that is going to become more interesting, and the approaches that we choose, exclusion versus integration or engagement, are something to track as well in terms of evolution of the asset class.
Okay, guys, thank you very much for your time. It's great to hear your thoughts on what is a very big topic, and so big. There's some issues we didn't touch on, unfortunately, but I'm sure there's plenty of room for this debate to continue outside of this discussion. I'd like to thank each and every one of you, of course, but I'd also like to thank our sponsors for making this happen: Allianz Global Investors, Candriam, and Jupiter Asset Management. Thank you very much, guys. Bye.
Thank you very much.
Thank you. Thanks.